I'm going to start by talking about wearables. You are very bullish on them. Your biggest investment is Fitbit, and just 2 hours ago, I'm questioning wearables when I was speaking to Under Armour founder Kevin Plank. What do you think about this big deal? I mean, this is a guy who makes shirts and shoes. He just dropped $560 million. He bought MapMyFitness last year to get into this game built off wearables. Mistake or genius?
Well, it's all about connected devices and connected wearables. That's the market is trying to play into, right? And so it's all about aggregating data and doing something interesting with the data so they can actually sell their shirts and everything because the data is actually useful. And that's an interesting consolidation of the market. That's actually quite a bit of change when you think about it for two apps.
But what gives you the confidence that having that data will translate into selling shirts and shoes? Like, it just seems like a whole lot of money for apps that don't make any.
It's a lot of money. I think they want to go into the game of fitness trackers. Fitbit today is clearly the market leader. NPD data last quarter said that so 66% of the trackers sold in the US were Fitbits. And since they launched their new category of devices, the Charge HR and the Surge, that number has gone to 75%. So out of 4 trackers sold in the US, 3 are Fitbits. And clearly Under Armour wants to play in that market by pushing their connected sort of swimwear.
But let's talk valuations. Software. Is there a number? When you saw those numbers, $560 million total, is that the right price?
It's a buyer's market. So in order to convince the investors...
Is it a buyer's market or a seller's market? I would say
it's a seller's market, in the sense that to convince those investors and executives that it was worth being taken out and not waiting for a bigger outcome, they had to put some numbers on the board.
How do you tackle in this industry, though, the retention rate? I mean, like Stephanie said before, she has like 17 devices in her
drawer. It's in a graveyard, in my nightstand.
In her wearable graveyard. I mean, okay, so you pay $500, $600 million for this, but why are people going to keep using it?
It's all about hooking up people around key data that are important to them. And, you know, I'm wearing my Fitbit, I'm looking at my number of steps every day, not only because I'm investors, because I want to stay fit. And if you can get people to either check those data a couple of times a week, or get them to share them with their friends.
Okay,
and actually run contests as to who's going to work the most. You're going to have an engagement.
Wait. If you like that about Fitbit, are you saying, damn, we should have bought MyFitnessPal? Do you wish Fitbit did this deal instead of Under Armour?
No.
Why?
Because I think that Fitbit on its own and its own apps has a lot of organic retention. If they want to get into other types of services like what MapMyFitness was doing, they could have done that deal. I don't know whether it would have paid that price. It seems pretty steep to me.
So you do think the price was high?
It's a seller's market.
I think that was a yes. That was a non-committal yes, is what that was.
I think it was a yes.
So where do you want to see Fitbit's strategy going? To make these kind of acquisitions, or to be bought out itself, or possible IPO? What is the best route for it?
So it's trying to figure out what are the holes in the product strategy that they have to cover on top of I mean, when you look at the family of devices we have the cheap sort of Zip, we have the entry price, we have the Charge, we have the Surge now, which is the watch focused really on sports, and so and we have the Scale. So it's a pretty sort of rich product line, and we're going to see how sort of that sells and what else we need to sort of offer, you know, to have a more complete sort of lineup.
Does that mean that, yes, some acquisitions might need to be there to complement?
So far, the company has really developed organically. I don't think that acquisitions are a no-no, but I don't think that we found anything that was interesting to us.
What is interesting to you right now?
To me, as an investor, or to Fitbit?
To you as an investor.
I spend a lot of time on new platforms, and we'll talk about drones in another segment, but drones, the blockchain, we look at virtual reality, augmented reality, and then we do a lot of very boring, unsexy software as a service investments.
What's your goal when you get invested in these kind of companies? I mean, do you want to see Fitbit go public?
The goal for us when we invest is to look at founders who are exceptional, who are building a very differentiated product in a market that could sustain a public company. It takes several years to develop. So for us, it's can we get to $10, $50, $100 million in revenue? And once you are around $100 million in revenue, you are sort of a big company, and then from there on, you don't really think about the potential outcomes. You just try and build the biggest company possible. One of the things that I learned when I started as a young VC 10 years ago or 14 years ago now, is good things happen to good companies. So build a good company, and then the exit or the outcome will take care of itself.
Good things happen to good companies, but you also have to have a lot of strategic luck.
Oh, yeah. And stars have to align. And, you know, I invested in Fitbit back in 2008 when they had this really big block of plastic, which was a connected podometer. And to me...
Pedometer.
Podometer, yeah. You don't like the French accent?
Nice.
I know, I couldn't understand what he said. I was just asking him to repeat himself. I'm saying pedometer?
Podometer.
Yeah.
I like the French way, don't worry.
Pedometer.
Thank you.
Yes.
And so invest in that on the basis of the thesis, which was we can build hardware companies on a capital efficient basis, because that was the whole thing with Web 2.0. You can build the next generation of market leaders on a very capital efficient basis.
If good things happen to good companies, why do we look at companies like Uber who can't get out of their own way? It's clearly, I'm going to say, I believe it is clearly a good idea, and in terms of the customer usage, it's really well executed, yet the world really seems like they are out to get Uber. If it's not the media, it's the regulators. If it's not the regulators, it's the Taxi and Limousine Commission. So there's an example of a company that's a good company, and good things ain't happening to them.
So good things happen to good companies is really sort of looking at the exit and not worrying about when will I IPO, when will I have an acquisition, and so on and so forth. In the case of Uber, they're really rubbing a lot of people the wrong way, and it's kind of interesting to see how Lyft is actually, their competitor, is actually really well beloved by their consumers and you know,
why?
the other
Tell me,
constituencies.
why? Is it just about the ethos of the management?
I think it's an approach where they've been more aggressive and they have a winner-takes-all sort of approach.
They being Uber.
Uber, yeah.
And Lyft is more welcoming to the whole sharing universe. You need a ride, I'll give you a ride.
It was all the,
friends.
you know, the pink mustache and the fist bump and everything.
So Lyft more like Adidas, Under Armour more like Uber?
The pink mustache, the fist bump.
I don't know that Lyft is dumb, based on which. Well, I think it's a different approach, and whether they become more mellow and they sort of, you know, figure out how to become more popular amongst the rest of the ecosystem, we'll see.